week is looking a lot like last March when a bunch of regional banks took a nosedive. And while this week was not nearly as bad, we've had no failures, at least not yet. It's been very bad for investors, and the main culprit appears to be commercial real estate. If you haven't been paying attention, here's what's happened in just the last 48 hours. Shares of New York Community Bank, which despite the name is actually a very big bank in the New York area, collapsing after it slashed its dividend and spooked the market. It's all about worries around commercial real estate and things like apartment and condo buildings having their debts go bad as prices in many big cities go down. NYCB has lost half its value in just 2 days. And that has been taking other banks down too, and not just regionals, by the way. Wells Fargo, for example, it fell 2% today. And the big regional bank ETF, the KRE, seeing its lowest 2-day performance since last year's Silicon Valley Bank crisis.
Well, I think one thing everybody can agree on was that yesterday was a shock, that we did have that plunge for NYCB, New York Community Bancorp, and that the reason behind it, as you mentioned, those swollen loan loss preserves 12 times the estimate. But beneath that, they also, in addition, cut their dividend. And the reason that they cut the dividend, because we don't know the composition for those loan loss provisions, but the driver of cutting the dividend had to do, the bank said, with office and multifamily commercial real estate. So this seemed like it was last year. I think that there are other experts, people in real estate, Manus, who might disagree with the CEO of Citizens, saying that there could be some kind of quote-unquote debt crisis ahead. That's according to one of my sources. Given the fact that you have 1.5 trillion CMBS due by the end of 2025, all of those factors that he mentioned, it really creates a backdrop for values to potentially fall. 80% of CMBS is held by the regional bank, so it is somewhat spread out. But we could have other situations, as occurred yesterday with NYCB. I think it's too early to say whether or not it's over, because a lot of these properties, they simply haven't traded. So we don't know how bad the distress is going to be. We don't know how bad the values are going to be. But some of the big office owners that I've talked to, mall owners that I've talked to recently in Bloomberg interviews, Manus, they've said that in New York here, values could drop as much as 25 to 75%. So basically, a loan would be worth 25 cents on the dollar from previous values. That could still be kind of painful, so stay tuned.
Okay, whether it is idiosyncratic or not, multitudes of idiosyncrasies can cause a big problem.
Okay, prices paid. This is not good, and this is what the markets are going to pay attention to. Prices paid for January expected to be 46.9, and that would have been, what, 9 in a row below 50. Some good celebration there, but it popped all the way up to 52.9. 52.9. That's the highest prices paid since April of last year. That's a couple of seconds. The first jobs report, jobs of 24 is out, and it is whopper 353,000. 353,000. We have to go in the Wayback Machine. That is the biggest non-farm payroll gains since January of 23, when it was 472,000. If we look at the average hourly earnings, a huge jump, up 0.6%, up 0.6%. It equals March of 22. To find a higher number, you have to go to January of 22. And also, for some context there, the amount of year over year is also popping 4.5%. We were expecting 4.1. The year over year average hourly earnings began as a data set in 2007, pre-COVID, all the way to when it started. The high was 3.6. It's 4.5.
Look, this means March is off the table. March should have been off the table for a while, as you and I have discussed, but this means March is off the table. It also means that you are more likely to get the 3 cuts that the Fed has signaled, 3 to 4, rather than the higher number that the markets has been romancing.
Do you think that May is potentially off the table too, Mohammed, given the fact that we're seeing wage pressures that are going in the wrong direction for the Fed?
You know, I was with you last week and I said June is what I think should happen and what I think is likely to happen. And that this report just feeds into that.
Mohammed, so what do you think it means in terms of the U.S. election? Can they cut closer to the election now, given March is off the table.
Jay Powell, the Fed chairman, is talking about a soft landing. Do you believe we will see a soft landing?
Well, I think he's going to do something to probably help the Democrats. I think if he lowers interest rates, but you have the potential of having massive inflation again, because the Middle East could drive up the price of energy. Energy has so much to do with it. And the Middle East, again, the bombs are dropping all over the place, and the ships are starting to get hit, and hit hard. If that happens, you're going to have tremendous spikes in the price of oil. And if you do that, you're going to have big inflation. He's not going to be able to do anything.
Explosions in Iraq and Syria overnight. Today, the US assessing the aftermath of Friday night's operation, involving, it said, 85 strikes and 125 precision munitions, while local reports say around 40 were killed. Targets on the Syrian-Iraqi border, strongholds of Iranian-backed militia accused of carrying out the deadly attack on a US base in Jordan.
But it looks to me like he's trying to lower interest rates for the sake of maybe getting people elected. I don't know.
So you think he's political? He's just going to cut rates to help Biden, you say?
I do. I think he's political.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case, or what we would call the base case.
All right. Today is Sunday, the 4th of February. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. And in this video, we're going to talk about the weird and dangerous economic phenomenon of interest rates going higher, adding pressure on the economy as anticipated. On one hand, you have trillions of dollars of debt accumulated under quantitative easing, under zero interest rates for years. Now, all of a sudden, all of this debt has to be refinanced at a higher rate. Now, all of a sudden, we see the value of properties, specifically in the real estate sector, that were bought during bubble times, being reduced in value. And this is adding a lot of pressure on regional banks and many other financial institutions that happen to be lenders to these commercial real estate properties. But on the other hand, we also have a huge bubble that is forming in the economy right now, led by government spending and the phenomenon of handful of large cap companies expanding their market cap in the stock market at an insane pace, causing perhaps one of the most overconcentrated and dangerous bubbles in market history. These names have become too big to fail now. And the most important question now becomes, how will the Federal Reserve balance all of these risks here? On one hand, to save regional banks and the crisis that we see in the real estate market right now, the Federal Reserve has to lower interest rates and end quantitative tightening, perhaps resume quantitative easing. The problem with that is it will bring back inflation. From one side, we still have inflationary pressures, now being amplified by the geopolitics. You also have government spending on steroids. That's going to continue to expand if we lower rates and resume quantitative easing. And likewise, if the Federal Reserve cuts rates, we will see the multiple expansion in these handful of names in the stock market continuing to go on. And this will drive inflation higher for longer, and perhaps we will see another shocking episode. On the other hand, if the Federal Reserve decides to say, you know what, the inflation risk is too high and the problems that we see in the real estate market and regional banks right now could be contained, so we're going to hold on in any decision to do rescue operations such as cutting rates or resuming quantitative easing. What if this problem gets out of hand, causing a recession in the economy, which will drag down these handful of very large market cap companies in the stock market down? And as we said, they're too big to fail. Billions, if not trillions of dollars now depend on them. They form more than 30% of the stock market. Retirees depend on them. If they go down, we will see a shocking crisis here. So with that background out of the way, here's the segment that you guys have been waiting and asking for to come back. So let's do it, and here it is. In focus tonight. Handicap. What would you do as the Fed chairman right now, as we see the phenomenon of the duality of the risk becoming more and more real. That is the risk of inflation and the risk of a recession. What we're seeing right now is bank failures are beginning to increase. This time around, banks hold more assets than they had back during the financial crisis, meaning bank failures will have more negative impact in the economy than before. And we all remember what happened back then. A few bank failures got out of hand, became contagious, and the economy suffered the greatest recession since the Great Depression. We all remember what happened last year with the failures of Silicon Valley Bank, First Republic Bank, and many others. And of course, in response, the Federal Reserve decided to unleash the Flex Seal fix, which in a nutshell, pouring more money into the problem and hoping that it's going to subdue. Now, the problem last year was higher rates causing assets held till maturity by certain banks to go negative in value. And as we've seen higher interest rates by the Federal Reserve, a lot of depositors didn't really want their deposits to be in a bank where they're not getting any return. So they shifted their deposits, taking them out of these banks to other holdings where they can get a return on their deposits. That left certain banks in the negative, scrambling to cover the hole from depositors exiting their banks. The losses magnified, and we've seen the collapse of Silicon Valley Bank. The Federal Reserve said, okay, any bank that sees an exodus from depositors looking for higher rates, and they can't really plug the hole because their assets held until maturity are now negative, well, you can plug the hole by borrowing money from the Federal Reserve. So if your depositors leave and you lose all of a sudden $10 billion worth of deposits, you plug that hole by borrowing the money from the Fed. And we were told that this is going to be a temporary fix. In time, interest rates are going to normalize and go down, and the exodus of depositors will also level off, and the crisis will be behind us. But as we see right now, almost a year later, these banks continue to borrow from the Fed's facility, not just because of the arbitrage reason, but also because they need these loans. The problem now becomes the Federal Reserve says that this is a temporary facility that will expire a little over a month from now. But if banks continue to borrow from this facility, can the Fed really cancel this facility at this point? And what happens to the obligations of these banks to the Fed? They have to pay the loans back. And now they're facing another risk that probably will not be mitigated by the Federal Reserve, which increases the chances that we will see more and more bank failures. What is this risk that we're talking about that is new from last year? The risk is, with higher interest rates sticking for longer, we see that a lot of real estate properties have lost value. A lot of these properties were bought under bubbles. For example, during zero interest rate policies, investors took debt from banks to buy properties and lease them as offices. But then came the pandemic, and we see the work from home phenomenon sticking with us. All of a sudden, the value of these office properties plummeted. And now all of these investors who took the loans to buy these properties have to refinance at a higher rate. Well, if they're not receiving rent from these offices being leased, how are they going to pay the debt back, let alone at a higher rate? So that puts the investor and the lender at risk. And it's not just in offices. We talked about hospital properties, for example. During the pandemic, the government money was flowing. Anybody who said, hey, I have a healthcare facility, I have anything related to COVID, they received free government money. So a lot of investors took loans at really low interest rates. They bought properties and they leased them to hospital operators, any healthcare facilities. But now that the government money stopped, at least in the healthcare sector related to COVID and hospitalization and all of that, a lot of these facilities cannot pay rent anymore. So what happens to the investor? How are they going to pay back the loans that they got from the bank, let alone at a higher rate now? So all of a sudden we see the contagion impact heading all the way to the lender, which is in most cases the regional banks. And the same goes for residential properties. We've seen a boom during the pandemic. Folks are moving all over the place. And before that, so a lot of companies took loans, invested in residential properties, building new apartments. Now, as folks moved during the pandemic, looking for single-family homes instead, and the supply of apartments continues to increase, we see the value of these properties plummeting. The investors are now on the hook. They can't really pay back the lenders, and the value of the loan went down. So you see the chain reaction, the dominoes here, falling one by one. And we see a real estate crisis morphing into a financial crisis, as we've seen back during the GFC. The headline reads, "A commercial real estate crash is unfolding and regional banks are feeling the pain." Gee, why? Why is that happening? The mayhem in regional banks reflects the malaise that gripped America's commercial property sector, which has a $2.2 trillion amount of debt due in 2027. Real estate experts have called the market a slow-moving train wreck, with a possible $700 billion default looming on the horizon. And just a small rout during this week of New York Community Bank going down, losing about 30% of its value in a single day, netted short sellers about $1.1 billion. And a reminder, we have over $700 billion of looming defaults. So this is a crisis that is just beginning here. And it's not just limited to regional banks or just U.S. banks. It is a worldwide phenomenon. Not just if you look at the Canadian real estate market, for example, or the Australian one, or the British real estate market. We have a lot of global banks that were investors for years in the U.S. commercial real estate market, and now they're feeling the pain too. For example, this week, the Japanese bank Zora, I believe, tanked over 20% after flagging losses tied to U.S. commercial properties. And you see that the delinquency rate is beginning to move higher here in non-owner occupied commercial real estate in the U.S. And just a little tick higher is causing all of these problems. If rates stay higher for longer, and they're way too high right now for this kind of stress in the real estate market, we will see more and more delinquencies and more banks, more lenders blowing up. When we look at the real, quote-unquote, federal funds rate, it is the highest in 20 years. Higher than the rates that caused the great financial crisis back in 08-09. And your question right now might be, well, gee, Maverick, why doesn't the Federal Reserve just cut rates at this point and save us from this problem? A, we can't say for sure and with a degree of certainty that inflation is gone. The moment you cut rates, inflation comes back. And oh, by the way, we have a political risk in an election year. The headline reads, "The Fed won't cut rates until after the 2024 elections." Economists say, what is he talking about? Here it is. Rate cuts won't arrive in March, May, or even June this year. Instead, they're going to come after the 2024 election. That is according to Santander's chief economist, Stephen Stanley, who expects only 2 rate cuts this year for a total of just 50 basis points. We've had 6 months now of the core PCE deflator running a little below 2%, he said. And I'm sure there are a lot of frustrated market participants saying, well, isn't that enough? And the answer is no. That is because, quote, noisy, end quote, categories like airfares, hotel rates, and used cars prices have been pulling inflation down so far, he said. But there is a political reason too. If the Fed begins cutting rates now, the risk of looking biased toward any presidential candidate is low. But introducing the first rate cut closer to election day is trickier, and it could be construed as a boost to incumbent President Joe Biden. I don't think they want to make newspaper headlines in the heat of the election season, Stanley said. Now, we are already seeing the Republican nominee, Donald Trump, already complaining about all of this, criticizing Fed Chair Powell for considering interest rate cuts this year to help the Democrats, as you've seen in the intro of the video. Furthermore, former President Trump says if he's re-elected, he will not reappoint Chairman Powell to head the Fed again. So now if Powell decides to cut rates at any point between now and the elections, he appears to be political and looking for his own ass at the end of the day. And that could bring a lot of criticism for Chairman Powell. That is a huge risk, and it raises the bar for rate cuts way too high. And folks, in past videos, we talked about why inflation went down. Mostly it's happening because of energy prices going down. That is because the increase of supply here in the US. But we know what's going on with the geopolitics. We know what's going on with OPEC. They could hold a surprise before the election season and decide to boost inflation higher. If the Fed decides to cut rates, we could see a phenomenon such as what we've seen back in 2008, the great short covering rally in oil, which drove prices to all-time highs. And we also have the problem of sticky housing inflation, not just in home prices, as we've seen from the Case Home Chiller Index this week, indicating that housing inflation is moving higher, but also from rents. Rents are sticky. They're not going down. The consumer is not feeling any relief from rents going down because they're not going down, at least not in real life. Nobody is leasing an apartment right now or a single-family home. Your landlord didn't knock the door and say, hey, you know what, the inflation rate is going down according to the Bureau of Labor Statistic Kitchen, whatever. So I'm going to lower your rent right now out of the goodness of my heart. That's not happening in the economy. What we see is new listings, or say the landlord last year was asking for price X and now they drove the price down by a little bit. But in real life, there is no tangible decrease in the prices of rent, and that's going to keep inflation higher. If energy comes back, that's going to push inflation, CPI, PPI, back to acceleration, and this will make the Fed's job even more difficult. Not to mention, of course, the stock market bubble that we see right now, led by a handful of stocks. That is allegedly causing consumer sentiment to rise sharply. Well, when consumer sentiment goes higher, then the consumer feels safer and they begin to use their credit cards more, accumulating more debt and causing more inflation. But the nail in the coffin for the March rate cut expectations to go poof gone was the quote blockbuster end quote jobs report that we got on Friday. The headline reads, U.S. economy added 353,000 jobs in the month of January, much better than expectations. Now, expectations were for 185,000 jobs, so this is almost double the number. Now, you know my stance about these government jobs data. I think they're all fugazi, they're all cooked. Just look at the revisions that we've seen so far. They give us one number and then later on they revise it down. And last year, they've overestimated jobs by over 400,000. So we can't take these numbers with any degree of credibility. But the damage is done because market expectations and any moves in the economy will be based on this number, whether it's real or not. I mean, look at what happened with jobless claims, for example, just a few days ago. Before this number came out, they went to 3-month high at 224,000. Continuing jobless claims also moving higher. During this earnings season, we've heard from companies issuing layoffs after layoffs after layoffs, thousands and thousands of employees. But again, allegedly, according to the government cooked data, we have created over 350,000 jobs in the month of January. So go figure. But again, you dig into the details and things don't add up. For example, there is a 9 million gap between number of U.S. jobs and the number of employed workers. So are we just creating imaginary jobs? Perhaps more part-time jobs filled by Americans to pay the bills and cope with inflation? Not to mention, of course, that the civilian labor force participation is going down. But on the other hand, we see that we're creating more and more government employees. So what's keeping this economy holding? What's keeping this inflation going and preventing the recession and complicating the Fed's job? A, it is the government spending on steroids via budget deficits, of course, and B, the stock market bubble that we see in the so-called Magnificent Seven, now down probably to 5, adding billions of dollars worth of value day by day as investors chase the mania and pour more and more money into these assets. Furthermore, when you look at the labor participation rate, that's actually dropping down. So how are we creating all of these jobs? Where are they coming from if the labor participation rate is going down? Full-time employment is also trending down. All of these are alarming signs when you peel the onion. But again, the headline reading, blockbuster report, and the end impact is, it is pretty much impossible for the Federal Reserve to cut rates anytime soon. It would not be justified, and Mr. Powell will be accused of being political. How can you cut rates when the stock market is at all-time highs and the U.S. economy allegedly is creating 350,000 jobs plus in 1 month? But then what about the crisis that we're seeing in regional banks? What about the crisis that we're seeing in the commercial real estate properties sector? Are those just gonna blow up because they need interest rate cuts to be saved? If that doesn't happen, they're gonna blow up and they're gonna drag everything down with them. For now, the Fed says, yep, we're not going to do any rate cuts right now. Even the IMF says that central banks should not rush into rate cuts. The former Treasury Secretary, Larry Summers, says that interest rates will remain above 3% all the way to 2030 because we have all of these inflationary dynamics that will prevent the Fed from cutting rates too much. Now, we just talked about over $700 billion in distressed debt in the commercial real estate properties sector that has to be refinanced by 2027. So if rates stay at 3% plus all the way to 2030, as Larry Summers suggests, that's going to be a major problem for the economy. Not to mention, of course, the geopolitical risk. We see what's going on with the Red Sea. We see that container shipping rates are moving higher. We see that the traffic through the Suez Canal is plummeting. So ships now have to take an alternative route, and that's going to cost more. Insurance rates are moving higher, and this could potentially move energy prices higher again. We see pressure on energy prices right now because rate cuts are not going to happen. We see all of these recession news showing up, and energy tends to be more sensitive and responds faster to these kind of news. And this is why oil prices went down this week. But who's to say they're not going to come back up? As we see geopolitical risk flaring up and we see all of these accumulation and inflationary pressures by container shipping rates moving higher, finally showing up in the economy. We have a lot of signs that goods inflation could be coming back as the consumer resumes spending using credit cards. As you've seen in the intro of the video, prices paid in the manufacturing survey jumped significantly higher. Well, that's going to be passed down to the end consumer, you and me. And another risk that will keep rates higher, despite the risk that we see in commercial properties and regional banks. Who's going to buy all of this debt that we're riding right now to finance the deficit and government spending? If we have more supply than demand, then we're going to have to offer higher rates on that debt to attract buyers. And that's going to keep rates higher for longer, which will cause a lot of problems in the economy, which will cause a lot of these banks to blow up, a lot of these properties to blow up. A major buyer of U.S. debt in the past has been foreign governments and central banks. But now we see, as the Chinese economy suffers, that the government of China is not really buying U.S. treasuries anymore. They're dumping more. Likewise, other central banks, now they see their own rates going higher. They're interested in buying their own bonds, not interested in buying U.S. debt, not to mention the geopolitical risk. A lot of folks, a lot of countries want to divest from the United States to other sources. We see central banks buying more gold now, not U.S. debt. The Japanese have been financing our debt for years, but we see in 22 that their appetite went down, only to rebound by a little bit in 23, but they're trending down again. Why? Because there is the possibility that as we see inflation showing up finally in Japan, the BOJ will begin to buy Japanese government bonds, which will begin to offer higher yields, and not buy U.S. debt instead. And we already see this phenomenon in other countries, in Italy and Germany. Rates have been negative for a while, so the German central bank and German government have been buying U.S. bonds for years. But now, since they have their domestic bonds offering positive yields, they're reducing buying U.S. debt. And soon enough, we will see the same phenomenon in Japan. Foreigners no longer have an insatiable appetite for U.S. government debt. That's bad news for Washington. The U.S. Treasury market is in the midst of major supply and demand changes. The Federal Reserve is shedding its portfolio at a rate of about $60 billion a month. Overseas buyers, or once important sources of demand, China and Japan in particular, have become less reliable lately. Meanwhile, supply has exploded. The U.S. Treasury has issued a net $2 trillion in new debt this year, a record when excluding the borrowing spree during the pandemic. U.S. issuance is way up and foreign demand has not gone up, according to Brad Sitzer, a senior fellow at the Council of Foreign Relations. He also adds, and in some key categories, notably Japan and China, they don't seem likely to be net buyers going forward. That's a major problem, which means we have to offer higher rates. That will keep interest rates higher in the economy. What about the trillions of dollars of debt that have to be refinanced at a higher rate? What about all of these companies that we just heard earnings from? They were positioning for lower rates to resume spending in the economy again. But now, as we see the prospects of cutting rates not happening anytime soon, those strategies will have to be reconsidered, which means we need to see more and more cost cutting by these companies, which means more and more layoffs. But folks, this concludes our macro discussion, but rest assured we now move to the market discussion, which kind of ties up here. You see, Federal Reserve Chairman Powell came out during the FOMC this week and at least attempted to convince the market that their interest rate expectations are way too high. The market is anticipating rate cuts by March, or at least was, and anticipating 6 to 7 rate cuts this year. Mr. Powell tried to convince the market that their expectations are out of whack, but of course he failed to do so. And the market went back to saying, oh, but maybe the Fed is going to cut rates in March anyways, and maybe the Fed will cut more. So if they don't cut in March, they'll do 2 rate cuts in the month of May. Why do we see the market fighting the Fed? Why do we see the addict mentality by the stock market right now? The answer is the Fed lost credibility. The Fed has been accommodative to the stock market for years. Any problem, the Fed comes in, plugs the hole, lowers interest rates, issues liquidity again. It's really hard to convince the market that this time it is different. This time they cannot afford to do that anymore. So we see bubbles forming in the stock market right now, the latest being Meta. Even though the report was, in my opinion, stellar. They've reduced costs, increased revenues, their margins went higher. But again, the stock shot up by 20% in a single day, adding value worth about $250 billion in a single day. On what really? Because the company created about $14 billion worth of profit in the quarter. Yet we added $250 billion worth of value into the stock because of that in a single day. And of course, it makes the rich richer. The CEO of Meta, Mark Zuckerberg, now seeing his wealth surging by about $28 billion in a single day. And this week alone, we have seen insane moves in certain stocks going out of whack. We'll talk about them in a second here, but this kind of revives memories of the dot-com bubble, dangerous bubbles. And I would say this one is the most dangerous because of the overconcentration. The headline reads, the stock market is reliving the dot-com tech bubble as the Magnificent Seven account for 45% of the S&P 500 gains to start the year. With a market cap of $12.5 trillion, the group has surpassed the GDP of major global cities like New York, Tokyo, Los Angeles, London, Paris, Seoul, Chicago, San Francisco, and Shanghai. And by the way, Meta aside, a lot of these companies are actually not showing impressive growth. They've grown negatively in the top line revenue year on year. They've grown negatively in profits, but we still see multiple expansion in some of these stocks as investors continue to pour billions and billions and billions of dollars into these stocks in a very overconcentrated bubble. You are now living through Tech Bubble 2.0. A 32-year market vet warns that stocks are doomed to suffer substantial losses with valuations at historic highs and the economy on the verge of a recession. What is he talking about? Here it is. In a January 22nd note, Wolfenbarger compared the current environment to the dot-com bubble in the late 1990s and early 2000s, during which internet stocks fueled the market to stellar returns before crashing spectacularly. For those of you younger than us who did not live through the tech bubble of the late 90s, you're now living through the Tech Bubble 2.0. As a reminder, the Nasdaq fell about 80% when that bubble burst in the mild recession of the early 2000s. Wolfenbarger said, given the fact that stock market valuations are even higher now than they were at the tech bubble peak of 2000, we would not be surprised by a similar decline in the coming recession. There is evidence that backs up Wolfenbarger's bubble claim, starting with fairly standard valuations measures like the chiller cyclically adjusted price-to-earnings ratio. While it's not as high as it was during the dot-com bubble, it is higher than it was in 1928 and is at one of the most elevated levels in history. Here's the problem, folks. Unlike the dot-com bubble, which we've seen a lot of speculation and some large cap names, of course, participated in that bubble, such as Cisco and Microsoft and many others. But for the most part, when these stocks crashed, it was a tech-led bubble, the boom and bust. But then after that, the Buffett stocks, the S&P 500 did not crash by much. It actually managed to recover really fast because the weighting of these tech stocks was not as high as it is right now. Not even close. Back then, these tech names were not too big to fail. Now they are. If you look at the market returns without the Magnificent Seven, for over a year now, we've been flat. Recently, we've added about less than 10% worth of gains in the S&P 500 x the Magnificent Seven, while the so-called Magnificent Seven added gains of about 60%. We look at the overconcentration again. You look at Russell 2000, mid-cap, rest of the S&P 500, Russell 1000 value. All of these returns are mediocre, really, in 23, until the rate cut mania that took place from November to December. And that's being priced out as we speak, now that we realize that rate cuts are not going to happen anytime soon. But the so-called Mag 7, they keep adding more and more value. What is that about? Sure, some of them are showing good returns, but nothing really out of the ordinary here. Nothing that justifies such outperformance. The only thing that does is multiple expansion and piling in, stampeding by investors' money into these names. And we have problems, folks. The concentration right now is way bigger than the dot-com bubble. 10 stocks form over 30% of the value of the S&P 500. If 10 stocks go down, they're too big to fail. They're going to crash the market down with them. What happens to the retirees? What happens to the mom and pop investors? What happens to the economy if these names go down? The overconcentration is real, folks. This is the most overcrowded trade right now, with 49% of money managers now say that the long Magnificent Seven trade is the most crowded. Even within the small cap index, the overconcentration is huge. We're talking about almost over 60% of the value of the Russell 2000 is concentrated in the top 10 names. When you look at the ratio of the Nasdaq to the Bloomberg Commodities Spot Index, we're now reaching the same highs of the dot-com peak when we've seen the crash. Another indicator that we have overconcentration, overvaluation in these particular stocks. And the equity risk premium is at 23-year low, meaning it's not really worth it investing in the stock market right now, with interest rates being positive and the risk of overvaluations and overconcentration that we see. Now you might say, but Maverick, but these stocks been producing massive gains. 20% in a single day. Question is, are you booking your profits in this mania or not? If you believe in timing the market beats timing the market, you'll be a victim of the bubble. And you're going to face the lowest equity risk premium in 23 years. The Bank of America bull to bear indicator is now closer to signaling a sell signal. We know that this is a conservative indicator. For example, the crash of 2018, known as Volumegeddon, happened at these readings right here, between 6 and 7. We also see investors' behavior, specifically after November and December. We've seen some broadening of the rally based on rate cut expectations. We now see investors saying, okay, maybe I missed the Max 7. I got to pick on junkier names that went down big. Maybe now they're going to recover because of interest rate cuts. And they're taking a lot of risk with these names. They rally for a little bit, then they go down again. We realize that interest rate cuts are not going to happen. Jeffrey Gundlach says that the stock market has shades of the dot-com and housing bubbles as investors move to junkier things, quote unquote. But folks, rest assured, if all of this commentary concerned you about the stock market, you got your boy Jim Cramer. He says that investors should not worry about big tech valuations. They're okay. They're fine. They're actually cheap. And another sign of concern, at least in my opinion, you see, in 22, we've had a lot of bearish views in the stock market. It was a concentrated point of view that in 23 we're going to see the beginning of the recession. And of course we did not. We got saved by the AI mania, the performance of the large cap names, and government spending. Now all of a sudden we see over-concentration on the other side of the aisle, where everybody's bullish. Everybody now believes in a soft landing. Most economists are betting on a soft landing. Most see that the stock market will add yet another double digits worth of returns this year. Most see no end of this AI mania. Most see that we're out of the woods, that the Fed is going to cut rates. But we see those who held on to the bearish view, that the recession is the inevitable outcome of this cycle right here. And the bubble will only add to the magnitude of the stock market crash. We see these voices now capitulating and leaving. The latest being Mike Wilson from Morgan Stanley. I see this as a sign of concern. When the bears begin to capitulate, and everybody becomes bullish, and there is only one voice in the room, that's probably when it hits. When we do the bubble analysis, folks, and see what's going on here, of course, the number one bubble is the Magnificent Seven bubble. But recently, we have seen at least two names, just like the movie, the Magnificent Seven, few of them die by the end. And recently we've seen that Tesla, that's probably dead now. They have a margin problem that's really, really hard to fix at this stage, as we see consumer demand weakening and costs not abating, and the company has a lot of problems with margins. It's going to become really, really hard for Tesla to return to performance here, so it is out of the Magnificent Seven. And in the latest report by the company Apple, the largest company in the world, the most important stock in the market right now, over $3 trillion worth of value, we see that growth in China is dropping down significantly. They missed on the iPhone sales estimate. We see that the service revenue is slowing down dramatically. And their latest innovation, not to join the AI mania and just do cheap and efficient pumping of the stock and the valuation of the company by promising some AI tools and innovations. They decided to go with these stupid goggles in the head for $3,000 plus. I believe that's going to be a mistake. Maybe the technology will have potential in the future, but right now, I believe that Apple is kicked out of the Magnificent Seven club. It's not showing impressive growth anymore. It is stalling. It is a maturing company, desperate for innovation. And unfortunately, the goggles is not it. They need to shift the AI, newer products, more efficient products. And that's not happening right now. So the names that are alive right now, NVIDIA, Microsoft, Meta, those three names have shown stellar growth so far. The valuations aside, of course, I have concerns about NVIDIA that at some point they're going to lose the pricing power. How long can you continue to sell these $40,000 a pop chip without facing A, oversupply at some point, or competitors showing up and reducing your profit margin and prices will go down? NVIDIA is now a $1.6 trillion market cap company that will earn just $9 billion in net income this year as sales drop off a cliff from China slowdown and the China ban. Let that sink in. That's another threat for NVIDIA, so we have to keep an eye on this stock, even though it is blasting higher, but that pushes the bar even higher. Now we have some concerns about Alphabet. They're losing growth, so that could be another name that could be kicked out of the club. And then you got Amazon. So far, so good for now. But notice the theme here. The companies in the Max 7 that have B2C business, business to consumer, the consumer is weakening. So growth and margins have stalled. And those are Tesla, they sell cars to consumers, and Apple selling iPhones and other products to us consumers. We're weaker than we were before. So these two are suffering. Amazon is a hybrid. Huge part of the business is B2C. For now, the consumer is spending on credit cards. There is no price sensitivity, such as Tesla and Apple. These two companies sell high-end products. Amazon, for now, survives. But at some point, as the consumer gets weaker, that's going to be a problem. And then we have to talk about their B2B component, which is AWS. If that begins to slow down or lose business to Microsoft, then Amazon could be kicked out of the club too. Alphabet, lots of concerns, but for now, holding. And then we'll look at the AI bubble all in all. We have the war that's going on right now in mostly large companies such as Oracle, Alphabet, Microsoft, Apple. But we also have some medium-sized companies such as ServiceNow. We see other companies such as Salesforce, Meta, SAP. All of these companies are competing in a war. Who's going to win the AI war? Which means you can cut costs for a limited time, but at some point you gotta have to spend more to beat your competitors, meaning that these margin pressures will show up once again in these companies, whether they like it or not. The bullet stacks for now continue to hold and outperform, such as AMAT, AMD, ASML, Broadcom, Taiwan Semi, NVIDIA. They provide the chips for these names that are competing in the war, the AI war. So for now, they enjoy higher margins, pricing power. But if the companies that are involved in the war begin to see that their consumers are slowing down in spending, the feedback will reach the bullet stacks. We see the mania ending. We have another bubble that's going on in the market right now. It's not just the AI bubble. Sure, we have the Ozempic bubble in names like Eli Lilly and NVO, but it's a smaller bubble when it comes to size and scale. A larger one, though, is the government spending bubble, the construction bubble. And in this bubble, we see stacks also acting as penny stacks, as technology stacks, just blasting higher. You have the raw material providers, such as Martin Marietta or Volcon. All of these companies have been doing excellent, and their stacks been rallying. Why? The government spending on steroids. The government just write the check, and these companies can charge whatever they want. And their pricing power increases, the margins do pretty good. Tools providers like Grainger and Fastenal have been doing pretty good. I used to own Grainger. I still own Fastenal, but I had to get rid of Grainger because I think that this mania is about to come to an end. We'll talk about that in a minute here. But you look at equipment stacks, Builders First Source, Eaton, Hubbell, Owens Corning, Trane Technologies, Caterpillar, Picard, all of these names that provide equipment in construction. Their stacks have been also surging like crazy. Installation and management stacks like Quanta or Top Build Home Services, or even the home builders such as Toll Brothers, Pulte, D.R. Horton, Lennar. All of these stacks are in a massive bubble right now. And I had some exposure to them since 21, but I had to de-risk and sell some of them because I'm not a believer in this timing the market beats timing the market, specifically when you have a transitory tailwind. That is government spending on steroids. We talked about the problem of financing all of this spending. Now that we have lack of buyers and rates will go higher and the government is now paying more to service the debt than the entire budget of defense. This is not sustainable. This is going to be an issue for this election. Fiscal responsibility, cutting the deficit, reducing government spending, because the other alternative is to tax more. We're already overtaxed. So I think that this bubble right here is also nearing its end and will slow down. Maybe we've already marked a blow-off top in some of these names. Grab a chart of Trane Technologies, for example, this week. A huge pop. Everything is overbought right now from a technical standpoint. I find it hard to believe that these companies will continue to add to these gains when the tailwind is government spending, and that's going to come to an end as we head to the election season. The single-family home mania is still here because of the lack of supply, so that continues to go on. But if the economy gets weaker, we're beginning to see, by the way, more and more layoffs. At some point, something is going to crack in the single-home family market, specifically from the investor side, because a reminder, a lot of them bought these homes in 21 and 22 at higher prices, and they took higher mortgages, higher loans. What if they can't rent these properties for higher rates anymore? Because we see the economy weakening, because we see oversupply in apartment buildings. All of a sudden, they have to dump these homes fast before they lose any more value. And the supply issue aside, this could cause the single-family home bubble to crash down and the outperformance by these names come to an end. Now, before we move on, folks, let's revise the weekly strategy from last week and share my new strategy for this week. So last week, the strategy was to go long USO calls, that is the oil fund, and TSLA. This is a bullish index for Tesla, so we're betting for a rebound, and to go short via Apple puts and AMD puts. Now, USO calls did not work out. There was potential for it to work out. At the beginning of the week, we got a drop. Then we got more demand showing up. We're back at the highs again, as you see in the hourly chart here. But we had to cut it off and take it off the table here once we lost the support of 71.10. Once that happened, we had to cut the exposure because this was an important and critical support to keep. And after that came the bad news for oil, which we're going to discuss in the commodities coverage in a minute here. Now, as far as TSLA, we got a nice pop out of it. In the beginning of the week, we got a rebound in Tesla, in this index here that tracks Tesla. It moved higher by over 10%. And most traders who followed the trade managed to walk away with decent profits here because options appreciate more than the shares. And when we look at Apple, for the week, it went down by almost over 6.5% before recovering a little bit on Friday. So this was the right call, even if you did not hold all the way till after earnings. You actually were better off closing it before earnings. The same goes for AMD. AMD went down since Friday by about 8% plus before rebounding and closing at the highs. So you had ample opportunity here even before earnings to close the trade at a profit. So what do we do now for this week? What we see is the dollar is now moving above its 200 days moving average after the massive jobs report that came out on Friday. Likewise, we see rate cut expectations going down, which means that yields in the 10-year bond is moving higher. Well, if we have the dollar and bond yields moving higher, wouldn't that add some pressure on dollar-sensitive names such as gold miners and on yield-sensitive names such as regional banks and small caps? So on Friday, I put in a strategy here of some exposures. You can pause and read it for yourself, but in a nutshell, what we're doing is we need to have one bullish exposure here in case we see the big tech / the NASDAQ mania continuing here into next week. And the cheapest way to do it is via SQs puts. The SQs is the 3 times inverse index of the NASDAQ, the triple Qs. So when the NASDAQ rallies, the SQs decrease in value. So we're betting on downside for the SQs here, upside for the Qs, via buying puts on the S triple Qs, and they're really, really cheap for the week. Even if you go to February 16th, they're really cheap. Now, on the bearish side, we want to go puts on the IWM, KRE, GDX, and the reason is the dollar and bond yields are moving higher. Now, if things change midweek, we're going to update you with the strategy here, but for now, I feel that we have a balanced exposure for next week. Anyhow, folks, let's expand the conversation here and cover the market information for last week and give you the outlook for the week to come. Now, we begin with the closing of the indices on Friday, and here we go. The diamonds were up by 134.58 points, or a gain of 0.35%. The NASDAQ led the pack. Thank you, Meta. Thank you, the technology mania. Up by 267.31 points, or a gain of 1.74%. While the Spider was also in the green by 52.42 points, or a gain of 1.07%. But here's the guy you want to keep an eye on. The yield-sensitive Russell 2000 small caps was down by 1.03 points, or a loss of 0.53%. If we look at the sectors on Friday, number one, of course, no surprise, we have Meta with a massive outperformance, up about 20%, so we see comp services on top here, followed by consumer cyclicals and technology. The laggards, the yield-sensitive utilities, real estate, and of course dollar-sensitive materials. For the week though, leading the pack, consumer cyclicals, defensives, and industrials. So it was sort of a different theme before Friday. And the laggards, energy, rate cut expectations go out of the window, energy is upset, and of course with higher yields and the regional bank crisis, which is revolving around real estate, we see real estate also lagging. And believe it or not, comm services for the week was actually negative, despite the 20% move in a single day by Meta on Friday. And the reason here is we have Alphabet down, I believe, more than 6% for the week. So that dragged down comm services in the red in the weekly performance. What about the market breadth on Friday? Believe it or not, big rally, right? The NASDAQ, the S&P rallying high. But then we look under the hood and we see that only 33% of the breadth on the NYSE was advancing, 65% was declining. Likewise, in the NASDAQ, only 35% advancing versus 61% declining. So in the assessment of the health of the rally on Friday, it's not really that healthy. That is a warning sign about the sustainability of the move by the indices on Friday. We'll talk about that in a minute in the charts analysis, but what about commodities? On Friday, energy down again. The WTI losing about 2%, Brent losing a little over 1.25%, gasoline RBOB losing a little over 2.25%, and diesel down about 1.5%, while natural gas oversold rebound of about 2%. Now, when we talk about what upset oil prices this week, of course, we got the news from Saudi Aramco that they're dropping expansion plans, and maybe that is a reflection of the demand environment. Maybe we're seeing a recession, at least in China. There is a stagnation phenomenon. Not to mention, of course, the data that we got, that the U.S. output is at all-time highs right now. So we have oversupply, and maybe demand is not that strong. Furthermore, we reduced the geopolitical risk a little bit when we got the news of ceasefire talks in the Gaza conflict. Good news for those impacted, not so good for oil investors. But I think the major news that upset oil, in reality, it's not really the ceasefire talk. It's not really concerns about demand. It is concerns about rate cuts not happening. You see, oil loves rate cuts. That's why when we have any economic crisis, any financial crisis, and the Fed responds by cutting rates, what is the number one asset and the fastest one to rally? The answer is oil. So energy investors were looking for rate cuts. The moment Jerome Powell came out and said, hey, no rate cuts by March, we've seen oil giving up, the crossing above the 200 days moving average and trending down. Not only that, it lost the 50 days moving average. So a bad look on the chart of oil right now, but again, we could see geopolitics flaring up more demand this week. We look at softs. The outperformance in commodities is concentrated here. Cocoa prices all-time high. OJ continues to show stellar performance here. It drops, then it gets picked up again, up about a little over 1.25% on Friday. Sugar also adding to the gains, up about 1.5% on Friday, along with marginal gains here, under 1% for cotton and lumber futures. Coffee down for the session about 1.5%, but again, it's been outperforming for a while now. With the dollar up about 1% on Friday, it is no surprise that we see metals down, even though I'm kind of surprised that they're not down more. So gold is down a little over 0.5 percentage point, a mild reaction here, maybe because gold is being bought as a hedge against geopolitics for now. But we see silver down about 2%, platinum down about 2.25%, copper down about 1%, and palladium down a little over 2%. Flash activities for meats on Friday, but we see declines in grains, led by soybeans, soybean meal, soybean oil down about 2%. Corn was down about 1%. Flattish activities for wheat futures, oats down a little over 3.25%, but rough rice, we've seen a lot of buying, unusual activities in buying call options on rough rice. It is up on Friday, a little over 1.5%. The dollar continues to rally. It's going to add a lot of pressure on metals, but keep in mind that gold has a massive tailwind here. So even when the dollar rallies, we see gold going down, but not by much. Why? Because central banks are now buying gold like mad. The demand is heading record high in the year 23. Geopolitical risk, China weakness, de-dollarization. So the demand for gold is still high. And even if we see the dollar going higher, the resiliency of gold is impressive. I'm not so sure about the resiliency of gold miners, though. And again, if the dollar continues to rally into next week, we'll see grains under pressure. We're probably going to see a lot of softs coming down. But energy relies on yields. If yields go higher in expectations of higher inflation or stickier inflation, we could see a recovery here in oil. Not to mention, of course, the geopolitical risk. We look at the weekly performances here for commodities. At the bottom, energy, RBOB, WTI, Brent. On the other hand, the winners, OJ and cocoa futures. Not good for chocolate lovers and orange juice drinkers. Not a lot these days. I happen to be an orange juice enthusiast and I eat a lot of chocolate, so not good news for me. Moving on to the big casino, the options market, what do we see here? The volume exploded on Friday. Understandably, because we have a lot of covering, we have a lot of chasing of the action that we've seen in Amazon and Meta. We have bettors now showing up that maybe Tesla's going to catch up. Hey, maybe Nvidia is going to also do the same move. So we have a lot of speculation here on Friday's session. Mostly calls, so we see calls overwhelming puts here, but the volume moved higher in names like Tesla. Meta, understandably, but Nvidia over 2 million contracts on Friday. Apple, you saw the stunning recovery, down 3%, 3.5% in the morning, and it closes flattish. Why? Because we've seen a lot of call options buying here, over 2 million contracts. So folks, a lot of the move that we've seen on Friday is due to the options market. So a lot of you said, hey Maverick, but the dollar is going higher. Yields are going higher. The jobs report is hot. Wages are going higher. The Fed is not going to cut by March or not even May. Why is the market going higher? It's options, baby. And that's transitory. That's a mechanical reason. It lasts until expiration and then we're done with it. Moving on to the unusual activities that took place in the options market on Friday. We continue to see these SPY butterfly put spreads week after week after week. It is an excellent strategy to bet against downside for the stock market, specifically severe downside without spending a lot. So you can buy naked puts. That's going to cost you a lot. If you're wrong, you're losing a lot. But if you do a butterfly strategy, which is you buy one put, in this case, the trader bought the 435. Then you finance buying that put by selling 2 to 1, the body of the butterfly, which is a put with a strike price that is lower than the one you bought. In this case, it's the 420. But then, of course, what if the SPY crashes by more than 15%? Then all of a sudden, you're in the hook. You bought the 435, but you sold 2 to 1 the 420. Now you're losing. How do you hedge against that? You buy the 405. And the bet here is really to have a drop in the SPY in case it drops double digits, but not more than 15% by the expiration date of March 22nd. Then the trader here will have cheap exposure to the downside. Of course, if it goes more than 20%, which we're not thinking that's the case, unless there is a crash, the trade will probably become a loser or neutral. But look at the pricing here. The 435, which is the main leg for the trader, cost them about 75 cents a piece. But they're financing this by selling the 420 2 to 1 at about $50 a piece, so they cashed in about $1. Now they can finance buying the 75 cents for the 435. And they have a credit of about 25 cents a piece now, so they use some of that to buy the insurance leg, which is the 405 for about $40 a piece. All in all, the entire investment here, folks, is about 15 cents a piece. And it gives you decent downside if there is a shock. We're not going to look at the trades for Meta. Folks are buying calls, betting on more upside. Folks are buying puts. That's a fool's errand, in my opinion, because all of these options are way too expensive right now. You need huge moves in the stock to make a buck. But folks, we've been seeing a lot of bullish activities in SNOW, Snowflake. Lots of calls. For some reason, maybe we have an announcement coming out soon. Maybe somebody knows something that we don't. Who knows? But here, the trader bought the 250 calls for the expiration date, February 23rd. The expectations, the name will rally higher and gain more than 14% by then. Paid about $1.50 a piece, tenor this trade. All in all, spending about $2.25 million. Then we have quite an interesting trade here for the ticker RELY, Rely. This is for Remitly services, and we see the immigration crisis that's going on in the borders right now. Lots of folks are coming in with no resources at all. This is a software company that provides services for immigrants. And the bet here is that the immigration crisis that we have in this country will be good for this name. So somebody bought calls here, the 20 calls for the expiration date, April 19th. The expectations, the name will rally and gain more than 12% by then. Paid about $1.40 a piece, tenor this trade. All in all, spending about $850,000. And then what about the ticker Wolf, WOLF? For Wolf Speed, an underperformer for the year, massive underperformance here, ties to Tesla, of course, so the name is down almost 40% for the year. Unbelievable. Somebody sees more downside to come here. They bought the 22.5 puts for the expiration date, March 15th. The expectations, the name will drop down and lose more than 15% of its value by then. Paid about $1 a piece, tenor this trade, all in all, spending about $600,000. Moving on to the heat map analysis, what do we see here on Friday's heat map? It was not a broad rally, folks. The indices were higher, and it was much worse in the morning. We've seen somewhat of a catch-up play by the end here. It was mostly Amazon, up about 8%, Meta up about a stunning 20%, and then, of course, moving NVIDIA and AMD and the AI mania stocks higher with it. So we see Microsoft higher, Snowflake with an impressive performance on Friday, up about a little over 9%. We've seen a rebound in regional banks on Friday, perhaps due to options. Folks short, they went down big, they're catching some profits. So we see a mild rebound in regional banks. We got some energy earnings, and investors were happy with Chevron, so Chevron was up about 3%. And again, healthcare remains a really strong sector here. So we see Cigna reporting earnings, the stock rallies. On Friday, EW, Edwards Life Sciences, adding to the gains for the week. But besides that, it was ugly. Yields going higher, so any yield-sensitive sectors such as utility, such as real estate, such as even staples, such as the dividend-paying names, even in healthcare, going down on Friday. And with the dollar going higher, we see gold miners going down. Now let's contrast this theme with the weekly heat map. What do we see here? A little better, but we have bigger names now in the red. When I say a little better, more performances by cyclicals, so we see the automobile manufacturers. General Motors, Ford, doing pretty good. Chipotle, CMG was up over 6% for the week. Industrials, we talked about the construction mania. All of these stocks were blasting higher. Grainger, Caterpillar, Eaton, a lot of industrials are in a bubble right now, but some not doing so hot, such as UPS shipping down about 10% for the week. Energy down with no rate cuts. We talked about the construction bubble, and we see in materials here, the building contractors like Martin Marietta, Vulcan, those stocks are going higher. Even steel providers like Nucor were higher. And we've seen good earnings from Corteva in agriculture, and that also boosted some names higher. Healthcare. Forget about the AI mania right now. I mean, look at some of these performances here. Look at names like Donner, for example, up over 5% for the week. Cigna, Edward Life Sciences, Stryker, the ticker SYK, moving to all-time highs, up almost 10% for the week. The Ozempic mania goes on, with Eli Lilly and NVO. But other names are also performing here, such as AbbVie, Merck, Amgen, good dividends, good performance, reliable. They perform in a slowdown, in a recession, in growth, so healthcare is a really good sector to be in here. The staples did pretty good. Now, we know that these stocks do pretty good in a recession, but also in a rate-cutting cycle. So you have to be careful here, because we see some enthusiasm and then they go down again. So names like Coca-Cola, PepsiCo, Mondelez, all did pretty good for the week. We talked about Meta, we talked about Amazon, even Tesla rebounding this week. And Nvidia, of course, up over 8% for the week. And then we have the credit card providers like MasterCard and Visa. Those outperformed for the week, and the reason is we get MasterCard earnings, and again, the consumer has no other choice. They have to use their credit cards. With higher rates, these companies cash in more. But what about the week, though? Forget about energy, UPS, we talked about that, but look at Google going down over 6.5%. Look at Apple down almost 3.5%. Look at Cisco down about 4%. Look at names like Altacian, the ticker Team. That's down over 12% for the week. Qualcomm down almost 6% for the week. And the regional banks, of course. So we have pockets of weakness here that is showing up. And for investors, you have pockets of strength. Without the bubbles that you see in the big caps or the AI mania or even the construction mania. You look at healthcare. That's providing you with some good exposure here. The staples, but you have to be picky here. You have to be careful and patient with the staples because their time to shine comes when the recession actually hits. Let's look at the heat map for the week. For the ETFs of the market here, and again, believe it or not, look at the market all in all. Large cap growth, Amazon, Meta, that's what led the performance here. Value was flattish. Mid caps flattish. Small caps were negative for the week. In international markets, China down, FXI down over 5.25%. But then we see Japan, India, that's where we see the outperformance for now, but I worry about India being in a bubble and just concentration by investors. I worry about Japan, Nikkei, hitting a double top. And then you look at the US market, it's pretty much flattish. We see some activities in the XLP staples. We talked about that. Some investors and money managers in the month of February, they decided to go with the recession theme, the rate cutting theme, and they bought some staples here. Whether that's going to last for the rest of the month or not, that's up for grabs. Industrials, the XLY, we know the construction mania. A lot of these names reported earnings this week, such as Grainger, such as Terrain Technologies. All of these names moved in a massive way, which I don't think is sustainable. The XLY, consumer cyclicals, thank you to Amazon. But then we see real estate down, we see energy down. Even technology was flattish for the week. The XLK was flattish. Chips were flattish, believe it or not. When you look at the equal weight SOXX, it was actually negative for the week. But then you look at the SMH, which is heavy in NVIDIA, that was positive for the week by about 1.5%. Then the KRE, of course, a massacre, down by over 7%. So you look at this map, folks, and you tell me, is this really broadening of the rally? Is this really a healthy market rally, or is it really concentrated in names like NVIDIA, Amazon, Meta, and the construction mania? But besides that, we're not seeing tangible returns here, specifically in the most sensitive and critical corners of the stock market, the cyclical sides such as small caps. Let's move on and do some charts and then wrap it up. We begin with the 30-minute chart of the SPY, the S&P 500. What we see here is, probably because of options, green candle after green candle after green candle on Friday. But the end impact is the RSI became really overbought. So I would not be surprised to see a pullback as we open in the morning. That could lead us down to 491.47. That would be support number one. And after that, we have 490. If we lose 490, we have a problem because that's going to erase the entirety of the gains from Friday. So those who want to short this rally that we got on Friday, you got to keep your expectations all the way to 490. If we lose 490, then that's going to open the path for more shorting to come. Now, for those who want to chase and join the rally here, Maybe you want to wait till 490, see how that's going to hold. Whatever dip we get, see how it's going to hold before you jump in right off the gate. And the reason is, you look at the daily chart for the SPY. We do have a bullish channel here, higher highs and higher lows. But we are at the higher end of the channel, number one. Number two, we have a negative divergence of the RSI, which says that the pop higher was weaker in terms of volume, participation, and relative highs to lows. That's a warning sign that these kind of pops are not sustainable, and they're probably going to reverse. Furthermore, add the Bollinger Bands to the mix here, and we see that we are at the top of the Bollinger Bands, so we have plenty of resistance here from the top of the channel, top of the Bollinger Bands, and then we have negative divergence on the RSI. You gotta be careful chasing here. I'd rather go down to at least the 20 days moving average before we see legitimate buy the dip opportunity, if that holds, of course. Any move higher from this point on will be out of whack. It will increase the danger of a bigger rug pull / flush down. We'll look at the weekly chart for the SPX. What do we see here? Again, we have a channel. Higher highs, higher lows, few divergences on the upside and the downside from the channel. But those divergences were quickly corrected. So my expectations are that we see this divergence right here. It will also meet a correction and we see the trading going back within the channel again. The problem is we have a psychological milestone, which is the SPX 5000. Could this be a point where traders want to see the tape go to 5,000 before they begin to sell? In either case, whether we go to 5,000 or not, you look at the RSI from a weekly standpoint. Now, in the daily, the RSI can be overbought. We dip down a little bit. The conditions are fixed, and we can see that overbought, oversold in the daily chart can last for longer. But on the weekly chart, it becomes really hard to sustain an overbought or oversold reading. So for now, you look at the RSI, we're really overbought. So the upside is really, really limited. The downside is plentiful. Furthermore, expand the Vortex indicator on the weekly chart, and you can see that the bearish indicator collapsed to lows we've never seen before, except during the COVID crash, just before it, and before the phenomenon of volume getting in 2018. So dangerous setup here. The saying goes, when everybody's fearful, you got to be greedy. But when everybody's greedy, you got to be fearful. And right now, what do we see? Is there any fear here? When you look at this indicator, absolutely not. But there is a lot of greed. So I think it is time to be fearful at this point. You look at the E-mini futures, the daily chart, for the S&P 500, what do we see here? Again, we're making highs in the pattern. But then you look at the RSI, we have negative divergence. And that's not a good sign. We broke out of the rising wedge pattern and quickly moved to highs. Again, an alarming behavior of the chart. Then you plug in the Bollinger Bands. We're at the top here, so we have plenty of resistance. Then we expand the MACD indicator. At some point, folks, we have something called the reversion to the mean in any rally, where the MACD has to go down to the zero line. And this has not happened since last October. So we're due. It's just a matter of time here. And every pop we're seeing right now is just pushing the inevitable and making the pullback even more dangerous and sharper. So once again, when you look under the hood, sure, moving to all-time highs, but with a lot of danger here. You look at the Qs, an hourly chart, what do we see here? On Friday's session, again, buying because of options, because of what's going on with the big cap earnings from Meta and Amazon. We got to the highs of the week again at around 429.85. We could not close above it. Now we have what appears to be sort of a wedge-ish pattern here. The MACD is at the highs, so we are overbought. The rationale would say that we have a pullback coming. If we do, we got 427.55 for support number one. If that doesn't hold, then we have down at 424.73. I would not say that the Qs is losing steam for good until it loses 421.33. If that happens, then we'll probably have a confirmation of a reversal going on. You look at the Qs daily chart, again, we have a narrowing channel right now with higher highs and higher lows. So it is a bullish channel, but there are signs of concern. For example, plug in the Bollinger Bands. Why couldn't we make the pullback all the way down to the 20, which is pretty much the lower end of the channel, as we've done before? It seems that the rebound is a little premature here. Furthermore, look at the RSI. Negative divergences. That's a warning sign that this rebound is not really healthy. It could snap down really fast. Of course, we need to look for a breakage in the pattern. So if we lose the lower end of the channel, then we have a problem here. If we lose the 20 for good, we have a problem here. But we're not seeing that right now. We look at the NDX weekly chart. What do we see here? We got a rising wedge pattern. It did break to the downside, only to be met with buying and a rescue operation. What is the problem here? We stopped short of the highs from last week. If that holds, then we probably have a double top, and then we have to look at the RSI. It's really overbought in the weekly. You always have to be careful when the weekly RSI becomes overbought. If that is the case and we stop here and we begin to trend down, Notice that the support, the legitimate support, is all the way down at around 16,550. So if we zoom into an hourly chart, we see plenty of gaps between where we're trading right now at around 17,665 and the support all the way down to 16,550. We can fill any of these gaps, and these gaps will provide support. If we fail, then we have to look down at the next gap, so on and so forth. Unless, of course, one gap provides support or we begin to trade higher again. Then we know that the dip is being bought and we're probably going to challenge the highs again. If we look at the NASDAQ futures, we have what it appears to be a rising wedge pattern, and we're having a hard time passing the resistance here. So we have higher lows, that's the good news. Bad news is the range is tightening, and we have negative divergence on the RSI. We already have negative momentum on the daily MACD. So yes, we're back at the highs, but with a lot of warning signs. When we expand the support line of the rising wedge, which goes all the way back to October of last year, we can see the corrections here, as small as they may, when the chart begins to roll over. And we saw that this week. And then Thursday and Friday came an operation of reversing this rollover. And we're back at the highs. But according to the RSI, this reversal came in weak because it is still at negative divergence. So what do we do in this case? Do you trust Thursday, Friday, or the rollover pattern that has been building on since the beginning of the year? I think the rollover will continue here because what we've seen Thursday and Friday is a pop based on a handful of names with higher weighting. Now these names become overbought in their own charts, not just the dailies, but the weeklies. So it becomes really hard for the NASDAQ to rally with who to continue to move higher here. So I would not be surprised to see the rollover continuing next week. But perhaps this is the most important chart, the IWM and hourly chart. What do we see here? We know that 193 is critical support, and the chart doesn't want to lose that easily. It is finding its way, so it gapped down 193 on Friday because rates went higher, but it's not finding enough energy to make it above the gap. We got to 195.33, and then we've seen a big sell again. That's a sign of weakness here in the IWM. If rates continue to go higher overnight, what do we see in the daily chart? Number one, we see that support 193. If we break that and we close below that on a daily basis, then we have more downside to come. The resistance becomes the 20 days moving average, in or around 194.44. If we close above that, then the IWM lives for another day. But then look at the negative divergence in the RSI. Expand the MACD indicator. We see negative momentum going on and building on here. So if I had to bet, I would say that the IWM goes down and breaks 193, not the other way around. Then we look at the weekly chart for the IWM. This could be a beginning of an inverse ABC pattern that leads us down to the 20 weeks moving average. The dollar, that's the head of the problem here. So long as the dollar is trending down or consolidating, as we've seen, at least since the beginning of the year, the market can defy the dollar and rally for a little bit, specifically under consolidation. But when we have a clear pattern of a breakout here, closing above the 200 days moving average, you see on Thursday we were close to say, okay, it appears that the dollar doesn't have the energy to crack above the 200. It appears that the dollar is going to lose the 20 days moving average. In that case, we want to be long stocks. We want to be long the gold miners. We want to be long any dollar-sensitive asset within the stock market. But comes Friday with a massive jobs number, we see the dollar popping above the 200. That's a warning sign. The dollar-sensitive names begin to react first, and then the stock market catches up to the fact. If we look at gold, again, gold has been resilient. The demand is all-time highs. It's an excellent asset to be in, and it's going to appreciate in value, no doubt about it. The problem is when the dollar breaks to the upside, it's going to be really, really hard for gold to maintain any upside. So for now, gold consolidates within a really tight Bollinger Band pattern. It's above the 20 days moving average. The dollar continues to rally. I would not be surprised to see gold losing the 20 days moving average, but for now, it's holding pretty good. Different picture in the gold miners GDX. Thursday, when we were talking about the dollar losing the 20 days moving average, big pop in the GDX. Comes Friday, the dollar makes it above the 200 days moving average. We see the GDX gold miners dropping down, erasing the entirety of the gains from Thursday. Where do we lean for now? We lean toward the dollar going higher, GDX going down. And the same goes for the SLV silver. It was doing pretty good above the 20 when the dollar appeared to be going down and losing its 20 days moving average. Comes the break above the 200 on Friday, silver loses the 20 days moving average. We'll probably face more downside if the dollar continues to rally into next week. What about UK oil, Brent oil? What do we see here? Talked about the wedge pattern. We got to break to the upside. There was optimism that we could make it above 85 and we have a recovery in oil here. But then came the bad news. The ceasefire news, that added up, but I would think think most importantly, the lack of rate cuts is what's upsetting oil here. So we see a break to the downside this time around. I think at the end of the day, we're going to settle within the wedge pattern, and the next breakout decides where we go next in oil here. I would look at the weekly chart as a more of an indicator here. And for now, we see a bearish engulfing candle. You look at the MACD indicator. We're supposed to cross in a bullish crossing, reversing the bearish momentum into bullish. Now we see the bearish momentum coming back in. So it is really critical. If this continues into next week, then we're probably going to break support in oil and head to lower lows. If we see a recovery, you see the MACD moving back up, closer to crossing the average in blue, then we're back on track here in oil, and higher we go. Last week, I said that the commodity is better than the stocks for now. This upcoming week, though, and perhaps for the next period, next few weeks or so, we will probably see oil stocks outperforming the commodity, specifically the refiners. If you look at the ticker CRAK, this is the refiners ETF. It's been doing pretty good. It's been holding despite the fact that oil prices went up, went down, but refiners have been holding pretty good on the weekly chart. Now we see a sloping line of resistance. If it is broken to the upside on a weekly basis, then we have more upside coming in refiners. Now we do have a gap in the weekly chart, which I don't like, so I would not be surprised if we close the gap first and then head higher again. But in my opinion, the refiners right now are better than the commodity and the big oil exposure. If we look at the 10-year yield, what do we see here? Big rebound on Friday off the lower Bollinger Bands, but also facing the resistance of the 20 days moving average. Suppose we make it above. Suppose we continue to rally higher in yields here. We will see yield-sensitive assets not doing pretty good. For now, home builders has been defying any move higher in bond yields. And for now, it appears that we're heading into a bullish reversal. So you see the MACD showing a bearish momentum in the red candles that you see, but now we're about to cross and maybe move into bullish reversal. This is why I say that I'm not going to short the XHB based on the rise in yields until I see a clear pattern that this chart is heading down. That would not happen until we lose 91.45. Now, you look at the IYR real estate ETF, a different look than the home builders. Look at the selling volume that came out at the end of the day. Huge red candle. We're below the 20 days moving average. We're below the 50 in blue. The momentum in the MACD remains negative, so is in the RSI. We do have support of the lower Bollinger Bands. But if yields continue to go higher, sooner than later, the 20 MA is going to cross below the 50 in blue, and we see a bearish crossing, and we're probably going to open more downside for real estate. The KRE, regional banks, also yield sensitive. An hourly chart, what do we see here? We see a bear flag consolidation pattern. So yes, we got an oversold rebound Thursday and Friday, but it's holding under 48.5. That's a problem. Without crossing above, most importantly, closing above 48.5, this bear flag could play out. We could see ourselves going down here in the KRE. Look at the daily chart. You see the clear pattern of rejection once we got a gap down at the 20 days moving average in white, and then we lost the 50 in blue, retested the 50, couldn't make it above, and the chart drops again, only to rebound because it got outside of the Bollinger Bands. The behavior right now, looking at the RSI, says that we're not oversold yet, which could open the path for more downside in the KRE as the lower Bollinger Bands expand to the downside, allowing the chart to go down. We do have support of 45.5. We'll see how that one is going to hold. If it doesn't, then we have more downside to come. How about the VIX Volatility Index, 4 hours chart? What do we see here? We broke outside of the falling wedge pattern, but we couldn't close above 14.13. While the market was rallying on Friday, the VIX was holding steady here. It did not decline by much. It is holding a pattern of higher lows. We can also argue that we have probably a bull flag pattern or another falling wedge pattern. Sooner than later, we'll make it above 14.13, and the next stop would be 15. What's really concerning right now, SPY all-time highs, but you look at the weekly chart of the VIX, look at the MACD here. Recently, every crossing when we see the MACD turning bullish, we see a move higher in the VIX, and last time it was higher by almost over 70%. The move before was over 60%. And the one before that over 50%, so we could see a big pop here. You might have read the headline that we have traders who are buying the April calls, betting on at least a 50% pop in the VIX. That makes me concerned that we make all-time highs on weaker momentum, and then the VIX pops and we see somewhat of a volume-getting phenomenon. What about the big kahuna apple? What do we see here in the daily chart? We got a rebound of the lower Bollinger Bands. I think options had a lot to do with the rebound, but we crossed below the 200 again. That's a warning sign. You look at the momentum, be it the MACD or the RSI, they're all weaker. They're all trending down. This could be just an oversold rebound, and we resume the downside in this upcoming week. And if Apple loses the 200 days moving average, losing it for good, that would be a major, major problem and a warning sign for the market. How could you rally when the most important stock is below its 200 days moving average? Now, you might point out to the last time when the stock crossed and closed below the 200 days moving average in October and say, but look, we lost the 200 and then we got a massive rally after that. The difference between now and then, last time around, we got outside of the Bollinger Bands in the daily and the RSI was oversold. Now we're not outside of the Bollinger Bands and the RSI is trending down. Still has room to go down before it becomes oversold. So if we trade, let's say 3 days below the 200 days moving average, it solidifies that we lost it for good. That would be a major warning sign here. What about a weekly chart for Apple? What do we see? We're above the 20 weeks moving average. That's the good news. The bad news is the momentum is being lost, whether you look at the MACD or the negative divergence in the RSI. Sooner than later, if we lose the 20 weeks moving average, the 20, then we have an inverse ABC pattern, which could lead us all the way down to the lower Bollinger Bands on the weekly chart. Souffle Tesla, daily chart, what do we see here? Most important numbers to watch, 193, we cross above, then we have an oversold rebound that continues to go on. But boy, if we lose 180, we got a problem here, folks. So Tesla shareholders, mark 180. You got a hedge here. If we lose 180, we got a problem, big one here. You look at the weekly chart. On one hand, we can say that like last time around, we're oversold, we're outside of the weekly Bollinger Bands, we deserve a rebound at least. Gotcha. Play the devil advocate though. Remove the Bollinger Bands and let's play the trend line instead. You look at the RSI, we're not really oversold, so if we want to go down to the lower end of the support line here, Tesla can lose yet another 10% before it becomes oversold in the weekly chart. And if you look at the monthly chart, 180 is the line in the sand because we lost it before and we got a rescue operation. We can't lose it again and get another rescue because this is going to solidify the head and shoulder pattern with the neckline being at 180. You lose that, it's probably going to unlock more downside for Tesla here. So you need to have a hedging strategy at 180. NVIDIA, 30 minutes chart, what do we see here? We took a put options trade midweek at around 6:30. We got a gap down right away. But I said 618 is my limit. If we trade above 618, I'm closing the trade right there and then because this is going to be as good as we're going to get in a pullback in NVIDIA. And that's exactly what we got. And after that, Friday comes a major pop. But do we see a warning sign? A bull flag followed by a bear flag pattern on the 30. I think it's going to give us a pullback. Question is it going to be a significant pullback or just down to the next support at around 654? So you have to look at 654. If that support holds, then that's as good as we're going to get. If we lose, then we probably can talk about filling the gap below. If you look at the weekly chart, though, we talked about the consolidation range and the process of gathering energy. All of that energy is being released right now in a violent way. And NVIDIA has the tendency of doing these violent breakouts, violating the upper Bollinger Bands as it did before. And I'm highlighting some of these instances here, as you can see back in 21 and again in 23. In 21, that marked the top and down we went. In 23, it marked a consolidation range for a few weeks all the way till the end of the year. So we know that we're getting closer to a top here in NVIDIA. Whether that's going to produce a reversal or consolidation, that's up for grabs. I think that earnings will be really good here as a decider. If we see weaker numbers from China, if we see that the pricing power is being reduced, it's probably going to be a top. If we see another good number and good guidance, but we don't see any reduction in the pricing power or lack of demand from China showing up, then it's probably going to be another consolidation range because the bar is already way too high. So again, earnings will be a decider here. Whether we do the usual, once you break above the consolidation zone, you go down and a retest at least, or is it just going to be a consolidation and then allowing the moving averages and the bands to catch up with the trade as it did back in 23? If we look at AMD weekly chart, sure, we got a drop and then reversal off the reversal and closing above the close of last week. But look at the RSI, way overbought, and the candlestick behavior looks eerily similar before the top of 21. So we have warning signs here that AMD, and by the way, I'm surprised that the guidance was weak. I did buy the stock in the fourth quarter in anticipation that AMD will eat away some of the market share from NVIDIA, but the guidance was weak, so I think there is no reason to pop the stock right now based on earnings. When will that message sink in? Maybe after NVIDIA's earnings. If that is the case, AMD goes down with NVIDIA. I think that we're getting in a really, really dangerous pattern here and closer to a topping pattern. Bitcoin, BTC, tulips, what do we see here? We still have the inverse in the shoulder. We're still above the 20 days moving average, so far, so good. We're not seeing any problem here. But if we look at the weekly chart, though, 40,000 becomes a really important support to keep. Look at the MACD. we're losing momentum, and it could be a beginning of an inverse ABC pattern if we lose the 40,000 mark. If that is the case, you look at a proxy like Coinbase, we can make an argument that it is consolidating underneath the 20 days moving average, underneath the most important line here, 134.33, but you look at the MACD, it's about to cross from bearish to bullish. You look at the positive divergence in the RSI. So we're still leaning bullish toward Coinbase, but we're running out of time. If Bitcoin doesn't pop, what's going to happen in Coinbase? Specifically, if BTC loses 40,000. We look at the weekly chart now. The MACD is losing momentum already. If we lose the 20 weeks moving average, we're probably going to unlock an inverse ABC just like the mother chart, Bitcoin. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? On Monday, tomorrow, we have the services PMI. Then we have, from Chicago, Zombie Goolsby. We'll see what he says about all of the dynamics that we have. We have the ISM Services Index. And again, another zombie from Atlanta this time around, Raphael Bostic. A lot of zombies from the Fed speaking this week. For example, Tuesday, the 6th, we don't have any macro data coming out, but we have zombies from Cleveland, Minneapolis, Boston, Philadelphia, all commenting on the recent dynamics that we see in the economy. Of course, with the recent jobs data, you can't really cut rates. What about the crisis that we see in regional banks, though? So we're going to be more sensitive to the commentary from the zombies, not so much to the macro data this week. Wednesday, the 7th, we have the trade deficit, and then again, lots of Fed zombies again from Boston, Collins, Richmond, Barkin, and Governor Bowman again, Governor Kugler this time around, and then we get consumer credit. Thursday, the 8th, we have initial jobless claims, wholesales inventories, and another round from Richmond, Tom Barkin. And lastly, on Friday the 9th, and this could be an important one, the CPI seasonal factor revisions. And this is how they're going to cook the CPI in the next reading. And after that, we have another zombie from Dallas, Lori Logan. With that, folks, I'm going to wrap up the coverage here. If you enjoyed the show, press the like button, subscribe, leave a nice comment, and consider joining us as a member for the daily coverage for the stock market and the macro data. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Whenever there is any doubt, there is no doubt. That's the first thing they teach you.